What's the real difference between assets and liabilities? Hey there! Do you know the real difference between assets and liabilities? When most people hear the term asset, they immediately think of things like stocks, bonds, and mutual funds. And when most people hear the term liability, they immediately think of things like credit card debt and mortgages. However, while these are indeed types of assets and liabilities, they are not the only types. There are actually 14 different categories of assets and 8 different categories of liabilities. Once you fully understand the real difference between assets and liabilities, it makes it much easier to manage your finances and build wealth over time. So let's get started. Number 1. The most common asset, cash. One of the most common assets is cash, and yet it's one of the least understood. Most people think of cash only as money in their bank account, but there's much more to it than that. Cash includes any money that is readily available to spend. It includes money in a checking or savings account at a bank, as well as cash on hand, and in transit, such as money in your wallet or purse, as well as checks and money orders. In addition, certain money market accounts are also considered to be cash equivalents and are just as liquid. In other words, cash is any money that you have access to and can use for spending within a very short time frame, typically less than 3 months. Now, why do so many people misunderstand what cash is? For one, they often don't distinguish between cash and near cash. Near cash are things like money in a certificate of deposit, CD, with a bank, which is slightly less liquid than cash, because it cannot be accessed without penalty until the CD matures. Or maybe you're resaving up for a down payment on a house and have a certain amount of money locked away in a separate savings account. That too would be considered near cash. Or even a security that is easily converted into cash, like a money market fund. To keep things simple though, we will focus on cash alone. This should include all of the cash that you have in checking and savings accounts, as well as any other accounts that are considered to be highly liquid. Number 2, the most common liability, credit card debt. Now that we've covered one of the most common assets, let's take a look at one of the most common liabilities. According to statistics from the Federal Reserve, total household debt in the United States is about $15 trillion. Out of this amount, almost $1 trillion is in the form of credit card debt. But not all debt is created equal. For example, a mortgage on your home is generally considered to be good debt because it is secured by an asset that is appreciating in value, while credit card debt is considered to be bad debt because it is unsecured and carries a high interest rate. When you carry a balance on your credit card from month to month, you are charged interest on the outstanding balance. This interest rate is usually quite high, which is why it's important to pay off your credit card debt as soon as possible. But credit card companies make it very easy to carry a balance month after month. They often offer introductory periods with low or no interest rates, making it tempting to take out large amounts of debt. However, once the introductory period expires, the interest rate can go up significantly, making it difficult to pay off the debt. Also, credit card companies use a variety of strategies to encourage consumers to carry balances, such as offering rewards programs and setting credit limits at or above the consumer's income level. All of these factors contribute to the high level of credit card debt in the United States. So if you're struggling to pay off your credit card debt, you're not alone. But it is important to try to pay it off as soon as possible in order to save on interest payments. Number 3, other types of assets. In addition to cash and credit card debt, there are 12 other types of assets. Here is a list of all 14 types of assets: cash, stocks, bonds, mutual funds, exchange-traded funds, options, futures, collectibles, precious metals, real estate, business ownership, intellectual property, cryptocurrencies, and other assets. If you want to learn more about the different types of assets and how to invest them, check out the links in the description below. Number 4, other types of liabilities. In addition to credit card debt, there are 7 other types of liabilities. Here is a list of all 8 types of liabilities: credit card debt, mortgage debt, auto loans, student loans, personal loans, lines of credit, leases, and other debt. If you want to learn more about the different types of liabilities and how to manage them, check out the links in the description below. Number 5, how assets can be used to create income. When most people think of assets, they think of things like stocks, bonds, and real estate. These are all assets that can appreciate in value over time, meaning that they can generate wealth for their owners. However, there are other types of assets that can also be used to generate income. One example is equipment. If you have a piece of equipment that is not being used, it may be worth selling it and using the money to generate income through other means. Another example is inventory. If you have excess inventory, you could try to sell it at a discount in order to free up cash flow. You could also consider using some of your assets to create a new income stream. For example, if you have a spare bedroom, you could rent it out on Airbnb. Or if you have a car that you don't need, you could list it on Turo and rent it out to others. By thinking creatively, you may be able to find ways to use your assets to generate income that you didn't realize were possible. Number 6. The importance of keeping track of your assets and liabilities. It's important to keep track of your assets and liabilities for several reasons. First, it gives you a clear picture of your financial situation. By knowing what you own and what you owe, you can see exactly where you stand financially. This can help you make better decisions about your spending and saving habits. Additionally, keeping track of your assets and liabilities can help you identify areas where you can cut back. Maybe you have a lot of debt that is costing you a lot of money in interest payments. Or maybe you have some assets that are not generating the income that you need. Either way, having a clear understanding of your financial situation can help you make changes that will save you money. Finally, keeping track of your assets and liabilities is essential if you ever want to secure financing. Whether you're trying to buy a home, start a business, or consolidate debt, lenders will want to know your financial situation before approving you for financing. By keeping track of your assets and liabilities, you can quickly and easily provide lenders with the information they need. Number 7. The best way to manage your assets and liabilities. The best way to manage your assets and liabilities is to create a spreadsheet that lists all of your assets and liabilities. In addition to the name of each asset or liability, be sure to include the date that you acquired it, the purchase price, and the current market value. You can update this spreadsheet on a monthly basis to reflect any changes in the value of your assets or liabilities. This will help you keep track of your progress over time and make adjustments as needed. If you find that you're not making progress, then you may need to take steps to increase your income or decrease your expenses. But if you are making progress, then you can feel good knowing that you're on the right track. Creating a spreadsheet is not the only way to manage your assets and liabilities. There are other methods that work just as well. However, this is the most effective and efficient method. It allows you to visualize your financial situation at a glance and make adjustments as needed. Number 8. The bottom line. The bottom line is that understanding the real difference between assets and liabilities is essential for financial success. By following the tips outlined in this video, you can develop a solid understanding of your financial position and make the necessary changes to improve it. Remember, the key to building wealth is not just about increasing your income, but also about decreasing your expenses and investing wisely. If you can follow these principles, then you'll be on your way to financial freedom in no time. Thank you for watching. If you enjoyed the video, then please hit the like button and subscribe for more content. Have a great day.